Hi everyone! Last week was quite volatile. Risk appetite improved significantly on Wall Street thanks to Jerome Powell's speech. However, investors were still mulling over the Fed's future steps on monetary policy. A stronger than expected non-farm payrolls report somewhat undermined bullish momentum. So the question of whether stocks have finally bottomed out still remains unanswered. Nevertheless, stocks were able to end last week with gains. Speculators also summed up monthly results. In November, the Dow rose by more than 3%, while S&P and NASDAQ appreciated by about 2 and 1% respectively. All three benchmark indices notched monthly growth. It is December now, notably a Santa Claus rally usually occurs this month. It's quite hard for analysts to predict any scenario given that the outgoing year was rather unsuccessful for stocks. All the usual patterns do not work anymore. Currently, traders prefer sitting on the sidelines as the Fed meeting is approaching. They are now assessing the likelihood of a shift to a dovish stance. They will continue to analyze economic reports published last week as well as fresh data. They are also looking forward to the release of the ISM Non-Manufacturing Index and the University of Michigan Consumer Sentiment Index. The Producer Price Index will also be in the spotlight. Watch our video review till the end and find out the latest market news. Please leave your comments down below. Let's start. A Santa Claus rally will largely depend on the Fed's rate decision. Monetary tightening throughout the year triggered a strong downward correction. This is why further movements in stock markets will be determined by the Fed's rate decision at the December meeting. Last week, the tone of Jerome Powell's speech was dovish. Was it a signal that the regulator could shift to less aggressive tightening? Perhaps traders failed to avoid wishful thinking again. Following Powell's speech, they began to factor in a smaller rate hike, so they do not rule out the possibility that the cash rate will not reach 5% by the end of the year, as previously expected. Time will show. Despite some dovish signals, Fed policymakers are strongly committed to further monetary tightening, albeit at a slower pace. There have been no clear signs of a steady slowdown in inflation yet. Restoring price stability will require holding interest rates at a restrictive level longer than expected, Powell noted. The central bank will have to lower demand. A way to do it is to increase unemployment. It may help the regulator to slow down wage growth. So far, the labor market has been quite resilient. The non-farm payrolls revealed that the economy added 263,000 new jobs in November. However, the average hourly wage unexpectedly jumped more than expected. It shattered assumptions that the Fed could take a pause in aggressive tightening. Besides, the majority of analysts do not expect the Fed as well as other major central banks to abandon rate hikes. If so, the downtrend in the stock market will persist. Last week, stocks were rather volatile on Wednesday and Friday. On Wednesday, Powell delivered a speech boosting a short-term rally on Wall Street. Dow Jones gained 2.1%, reaching a 6-month high. The S&P 500 index climbed by 3% and the NASDAQ rose by 4.4%. However, by the end of the week, the sentiment changed considerably. Stocks dropped sharply following an upbeat NFP report, but later they offset losses. On Friday, the S&P and NASDAQ closed with a small drop. The Dow rose by 0.1%. The stock indices kicked off the new week on a pessimistic note. Traders are rather cautious ahead of the Fed's meeting, yet the expectations of a slowdown in monetary tightening are still quite strong. In addition, Jerome Powell admitted such a possibility in his speech. The Dow Jones showed their weakest performance last week compared to other stock indices. Over the week, it grew by 0.1%. Despite a lull on Wall Street, investors remain alert to any signs of a December rally. For instance, the confirmation of smaller rate hikes by the Fed could be a strong driver for stocks. The news about the easing of virus restrictions in China may also improve market sentiment. However, traders should bear in mind that stocks will decline immediately if the geopolitical situation worsens. Besides, it may happen at any moment given the geopolitical tensions around the world. Therefore, it's extremely difficult to choose a strategy. The S&P 500 index climbed by 1% last week. Like other indices, it rose sharply on Wednesday. It made an attempt to move higher, but there were no drivers. Even if bullish momentum remains strong, it's unlikely to jump above 4,150. The downward correction looks more feasible. The resistance level is located above 4,010. If the index fails to consolidate above this level, it will be a clear signal of a downtrend. For the last 2 weeks, the index has been hovering around the 4,000 level. So far, the bulls have been able to defend this high. Perhaps this is due to the fact that those market players who bought the rumor are in no hurry to sell the news. A psychological factor also plays an important role. A month and a half ago, the market was gripped by pessimism, short selling prevailed. Then dovish signals appeared and investors became overly optimistic. If they decide to close short positions, it will facilitate growth in the equity market. No matter how much investors would like to see a steady rally, it will not happen overnight. It's high time to take a pause. This is exactly what is happening now. The S&P index is sliding down. It may dip below 3,900. If so, we could see a double top pattern. Analysts are looking for signs of this pattern on the charts. Nevertheless, a breakout of 4,150 is still possible. In this case, the index may reach the range of 4,055, 4,155. If it rises above 4,155, it may signal an upward reversal. The next resistance level is seen at 4,310. The NASDAQ 100 logged the best performance last week. It climbed by 2.1%. However, on Monday it was in the red zone. There are risks of further correction until investors get more clues about the Fed's plans and study fresh inflation data. According to the Fed funds rate futures, the chance of a 50 basis point rate hike at the December meeting totals almost 80%. Only 21% of traders are still betting on a 75 basis point rate hike. As for the earnings season, Okta shares soared by more than 26% amid a stronger than expected profit report for the third quarter. The revenue forecast for the fourth quarter also topped Wall Street expectations. Not all companies were able to boast of such positive results. Marvell Technology shares fell by 5% as their semiconductor manufacturer missed quarterly revenue and earnings estimates. On Monday, Nick Reed announced he would step down as Vodafone chief executive by the end of the year. He will be replaced by finance chief Margarita Della Valle during the search for a successor. This is a positive news for the company. During the 4-year tenure of Nick Reed, the company's shares have fallen by more than 40%. Last month, Vodafone slashed its full-year cash flow forecast and lowered earnings guidance, citing soaring energy costs and economic woes in Germany, Italy, and Spain. Meanwhile, the prospects of large corporations have been significantly affected by China's zero-COVID policy. Tesla plans to cut the December output of the Model Y at its Shanghai plant by more than 20% from the previous month. China has partially eased some restrictions for people and businesses, but many of them are still in effect. It put the brakes on the auto market due to the disruptions in supply chains. Elon Musk said that China, Tesla's second largest market, was in the recession of sorts. Nonetheless, the company increased production in Shanghai in October at the fastest pace in history. Tesla's sales in China nearly doubled in November from a year earlier after the automaker cut prices and offered incentives for its Model 3 and Model Y cars. Perhaps Tesla will be able to offset in early losses. It's now planning to focus on production in Austin and Berlin. Tesla shares plunged by about 50% compared to the historic high in November last year due to soaring inflation and pessimism in the stock market. That is all for now. Subscribe to our channel and stay up to date with the latest market news. See you!